This guide will take you through the journey of obtaining personal funding, ranging from $10,000 to $400,000, exploring various pathways, strategies, and tips to help you achieve your financial goals. Let's dive deep into this extensive topic to give you the knowledge and confidence to unlock significant funding opportunities. Chapter 1: Understanding personal funding. Before diving into the specifics of how to obtain funding, it's important to understand what personal funding is and why it's a crucial tool in achieving personal and financial goals. Personal funding defined. Personal funding refers to the financing options available to individuals for personal or business use. It is typically obtained through loans, grants, or credit lines, and the funds can be used for a variety of purposes, including starting a business, debt consolidation, education, personal investments, or even real estate. Why personal funding? Access to capital can be the deciding factor in whether your ideas or dreams come to fruition. Whether it's a side business you want to launch, paying off large debts to free up cash flow, or investing in long-term personal development, personal funding offers the financial means to push your vision forward. Chapter 2: The importance of financial preparedness. When aiming for personal funding in the $10K to $400K range, financial preparedness is key. Lenders, investors, or grant committees will expect you to have a clear financial plan. 1. Assess your financial health. 1. Credit score. Start by reviewing your credit score. 1. It's one of the most important factors in determining your eligibility for loans. 1. If your score is low, work on improving it by paying off outstanding debts, disputing inaccuracies, and making timely payments on current loans or credit cards. 2. Debt-to-income ratio. This ratio determines how much of your income goes toward paying off debts. 2. The lower the ratio, the more appealing you are to lenders. 3. Savings. Having savings can strengthen your financial profile and demonstrate your ability to manage funds responsibly. 2. Create a solid financial plan. 1. Business plan. If you're seeking funding for a business venture, ensure your business plan is clear, detailed, and well-researched. 1. This plan should include your business's mission, goals, target market, financial projections, and how you intend to use the funds. 2. Personal budget. Even if you're seeking funding for personal use, having a clear budget will help you track how you will allocate the money responsibly and avoid unnecessary expenses. Chapter 3: Exploring different types of personal funding. There are several pathways to securing personal funding. The type you choose will depend on your specific needs, financial situation, and long-term goals. Below are some of the most popular methods. 1. Traditional bank loans. What is it? A traditional personal loan from a bank offers a lump sum of money, which is repaid in fixed installments with interest over a predetermined period. Bank loans are available in amounts ranging from $10,000 to $400,000, depending on the borrower's creditworthiness and income. Eligibility criteria. 1. Strong credit score, typically 650 and above. 2. Proven income. 3. Low debt-to-income ratio. 4. Collateral for secured loans. Pros. 1. Fixed interest rates. 2. Predictable repayment schedule. 3. Available in large amounts. Cons. 1. High eligibility requirements. 2. Can take time to get approved. 3. Risk of losing collateral in case of secured loans. Application tips. 1. Prepare all necessary documentation, proof of income, credit report, tax returns. 2. Consider working with a financial advisor to ensure your application is complete and well prepared. 2. Personal lines of credit. What is it? A personal line of credit functions like a credit card, allowing you to borrow up to a preset limit and pay interest only on the amount borrowed. This option is excellent for those who need flexible funding over time rather than a lump sum. Eligibility criteria. 1. Similar to a traditional loan, good credit score, income verification, low debt-to-income ratio. Pros. 1. Flexibility, borrow only what you need. 2. Pay interest only on the amount borrowed. 3. Revolving credit, as you repay, your credit becomes available again. Cons. 1. Variable interest rates. 2. Harder to qualify for than standard loans. 3. Temptation to overspend. 3. Business loans for entrepreneurs. What is it? If you're starting or expanding a business loan can provide substantial funding. These loans are available in varying amounts, often exceeding $400,000, for businesses with proven revenue models or solid business plans. Eligibility criteria. 1. Clear business plan. 2. Proof of existing revenue, for established businesses. 3. Good personal and business credit scores. Pros. 1. Tailored specifically for business growth. 2. Potential tax benefits. 3. Flexible repayment terms. Cons. 1. Requires a solid business plan or revenue. 2. Higher interest rates for startups. 3. Extensive paperwork. 4. Grants and scholarships for education and business ventures. What is it? Grants and scholarships are ideal forms of funding because they don't need to be repaid. While most grants target businesses, education, or research, there are personal development grants available in specific industries. Eligibility criteria. 1. Specific to the type of grant/scholarship, for example, academic, business, or personal achievement. 2. Proven need or merit. Pros. 1. No need to repay. 2. Can fund specific needs without increasing debt. Cons. 1. Highly competitive. 2. Lengthy application processes. 5. Peer-to-peer lending. What is it? Peer-to-peer lending platforms connect borrowers directly with individual lenders. This form of lending often has more lenient requirements than traditional banks and offers loans between $10,000 and $400,000. Eligibility criteria. 1. Moderate to good credit score. 2. Proof of income and financial stability. Pros. 1. More accessible than traditional bank loans. 2. Faster approval process. 3. Flexible lending terms. Cons. 1. Higher interest rates than banks. 2. Potential for scams or untrustworthy lenders. 6. Crowdfunding. What is it? Crowdfunding is a way to raise money for your personal or business needs by collecting small contributions from many people. This is done through online platforms like Kickstarter, GoFundMe, or Indiegogo. Eligibility criteria. 1. A compelling story or business idea. 2. A clear funding goal and rewards for contributors, for business campaigns. Pros. 1. No need to repay funds. 2. Gain exposure and support from a community. 3. Can raise large amounts of money quickly. Cons. 1. Highly competitive. 2. No guarantee of success. 3. Requires a solid marketing campaign to gain contributors. Chapter 4. Managing and repaying your funding. Once you've secured personal funding, managing it wisely is key to achieving long-term success. Create a repayment plan. 1. Set a budget. Make sure your budget reflects the loan repayments or credit utilization. 1. Stick to your plan to avoid falling into debt. 2. Avoid overborrowing, only take what you need and can realistically repay. 2. This prevents unnecessary financial stress. 3. Refinancing options. If your financial situation improves or you find yourself struggling to make payments, explore refinancing options that offer lower interest rates or more favorable terms. Chapter 5. Final thoughts on personal funding success. Securing personal funding between $10,000 and $400,000 can be the stepping stone to realizing your dreams, whether it's launching a business, buying your dream home, or investing in your future. The key to success lies in understanding the funding options available, preparing a solid financial plan, and using the money responsibly. Stay focused on your financial goals, and with the right approach, you can unlock the resources you need to succeed. Chapter 6: Building Strong Credit for Larger Personal Funding Opportunities. Key aspect of obtaining larger amounts of personal funding, especially closer to the $400,000 range, is having a strong credit history. Lenders use your credit score and history as a measure of how likely you are to repay the loan, making this a crucial factor. 1. Understanding credit scores and their importance. Your credit score is a 3-digit number, typically ranging from 300 to 850, that reflects your creditworthiness. Higher scores are linked with lower risks in the eyes of lenders, making it easier to qualify for loans and secure favorable interest rates. Key components of a credit score. 1. Payment history, 35% of the score, whether you've made past credit payments on time. 2. Credit utilization, 30%, the amount of credit used compared to the total credit available to you. 3. Length of credit history, 15%, the longer your credit history, the better, as it gives lenders a better idea of how you manage debt over time. 4. Credit mix, 10%, a combination of different types of credit accounts, such as credit cards, mortgages, and auto loans. 5. New credit inquiries, 10%, too many recent credit inquiries can signal potential financial stress. Why your credit score matters. 1. Loan approval. A higher credit score increases the chances of being approved for loans, especially large ones like $100,000 or more. 2. Interest rates. Lenders often offer better interest rates to borrowers with higher scores, which can save you thousands of dollars over time. 3. Credit limit. With a strong credit score, you're more likely to be approved for higher loan amounts, especially if you need significant funding, such as $200,000 or more. 2. Steps to improve and maintain a strong credit score. Whether you're just starting out or rebuilding your credit, there are several strategies to improve and maintain a strong score to maximize your chances of securing larger loans. Pay bills on time. Your payment history is the most important factor in your credit score. Always pay your credit card bills, loans, and other debts on time. Even one missed payment can drop your score significantly. Keep your credit utilization low. Try to keep your credit utilization below 30%. For example, if you have a $10,000 credit limit, try not to use more than $3,000 of it. If you're close to maxing out your credit cards, it can negatively impact your score. Diversify your credit. Having different types of credit, such as a mortgage, car loan, and credit cards, shows lenders that you can manage various forms of debt responsibly. Just make sure you're not overextending yourself financially. Limit new credit inquiries. While it's tempting to apply for new credit cards or loans, too many inquiries can hurt your score. Only apply for new credit when necessary. Monitor your credit report. Check your credit report regularly to ensure there are no errors or fraudulent activities that could negatively impact your score. You can get a free credit report annually from major credit bureaus like Equifax, Experian, and TransUnion. Chapter 7: Finding the right lender. Not all lenders are created equal. Depending on your financial goals, you'll want to find a lender who can meet your needs and offer competitive terms. 1. Traditional banks and credit unions. For larger personal loans, traditional banks and credit unions are often the first choice. They typically offer competitive interest rates and are reputable institutions. Pros. 1. Reputable and well-established. 2. Access to larger loans, especially in the $100K to $400K range. 3. May offer additional financial services like investment advice. Cons. 1. Stricter eligibility requirements. 2. May require collateral for larger loans. 3. Longer approval process. Tips for choosing a bank. 1. Compare interest rates. Interest rates can vary significantly between banks, especially for larger loans. 2. Look for added perks. Some banks offer perks like no-fee checking accounts, financial management tools, or even rewards points for personal loans. 3. Relationship with your bank. If you already have a good relationship with your bank, for example, multiple accounts, a mortgage, they may offer you more favorable loan terms. 2. Online lenders. The rise of fintech has introduced many online lenders into the market, offering an alternative to traditional banks. These platforms are especially helpful for those looking for quick approval processes or those with less than perfect credit scores. Pros. 1. Fast approval process, some approvals within 24 to 48 hours. 2. May have more lenient eligibility requirements. 3. User-friendly digital platforms. Cons. 1. Higher interest rates compared to banks. 2. Some lenders may have hidden fees or unfavorable terms. Top online lenders. 1. Lending Club, known for peer-to-peer lending and quick loan approval for both personal and business loans. 2. SoFi offers large loans with competitive rates and no fees, particularly for individuals with strong credit. 3. Upgrade, good for those with average credit, offering a range of personal loan options up to $50,000. 3. Private lenders. Private lenders can also be a good option for securing significant funding, particularly for those who may not qualify for traditional loans. These lenders include wealthy individuals or groups willing to lend money to borrowers for personal or business reasons. Pros. 1. More flexibility in terms and conditions. 2. Potential for negotiating better terms. 3. Less concern about traditional credit scores, depending on the lender. Cons. 1. Higher interest rates and fees. 2. May require personal guarantees or collateral. 3. Less regulation, so choose your lender carefully. How to find private lenders. 1. Networking within business circles. 2. Through recommendations from financial advisors. 3. Online platforms that connect borrowers with private lenders. Chapter 8. Common pitfalls to avoid when securing funding. Securing a loan, especially in the higher range, $100,000 and beyond, can be a game changer, but it's important to avoid common pitfalls that can lead to financial trouble. 1. Overborrowing. It's tempting to secure the maximum amount of funding you're approved for, but overborrowing can put you in a precarious financial position. Only borrow what you need, and be realistic about how much you can repay. How to avoid overborrowing. 1. Set a budget. Outline exactly how the funds will be used. 1. This will help you avoid borrowing extra money that you don't need. 2. Plan for the future. Consider your financial obligations down the road. 2. Can you continue to meet your monthly payment obligations if your income fluctuates? 2. Ignoring loan terms. The terms of your loan can significantly impact your financial health. While it's easy to focus on getting approved, make sure you fully understand the repayment schedule, interest rates, and any associated fees. Key terms to watch for. 1. Interest rates. Fixed rates are predictable, while variable rates can change over time and may increase your payments. 2. Fees. Some lenders charge fees for loan origination, late payments, or prepayment. 2. Understand all the potential costs before signing. 3. Repayment schedules. Make sure the monthly payments fit comfortably within your budget, and ask about the consequences of missing a payment. 3. Failing to explore all options before settling on one form of personal funding. Make sure you've explored all your options. You may find that a different type of loan or funding source better suits your needs. Steps to take. 1. Compare multiple lenders. Don't settle for the first offer you get. 1. Compare loan terms from at least 3 lenders to ensure you're getting the best deal. 2. Consider alternative funding. If you're struggling to qualify for a traditional loan, look into crowdfunding, peer-to-peer lending, or grants. 3. Consult with financial experts. If you're unsure about which type of funding to pursue, a financial advisor can offer personalized guidance based on your goals. Chapter 9. Scaling your success with larger funding. Once you've successfully secured your initial funding, you may find that you need additional funds as your business or personal ventures grow. Scaling your success with larger funding requires careful planning and strategic thinking. 1. Expanding your business or investments. If you've used your initial funding to start a business or make investments, scaling up may require additional capital. This could include expanding operations, hiring employees, or investing in new technologies or equipment. Key considerations for scaling. 1. Growth projections. Before seeking more funding, make sure you have a clear understanding of your business's potential for growth. 1. Investors and lenders will want to see evidence that your business can scale profitably. 2. Additional funding options. If traditional loans or credit lines are no longer sufficient, consider venture capital, angel investors, or partnerships. 3. Risk management. With greater funding comes greater responsibility. 3. Make sure you have contingency plans in place to manage risk and ensure long-term success. 2. Continuing personal development. If your funding was for personal growth or educational opportunities, scaling success means continuing to invest in yourself. This could involve seeking higher education, attending conferences, or developing new skills. Maximizing personal development. 1. Set long-term goals. As you achieve your initial goals, continue setting new milestones to ensure ongoing progress. 2. Seek mentors or advisors. Find experienced professionals who can offer guidance as you navigate the next stage of your personal or professional growth. 3. Use your funds wisely. Just because you have access to more money doesn't mean you should spend it recklessly. 3. Continue budgeting and using your funds strategically to ensure long-term success. Chapter 10. Final reflections on personal funds. Chapter 11. Strategies for repaying large loans efficiently. Once you've secured significant personal funding, one of the most important steps is developing a repayment strategy. Proper planning can help you avoid excessive interest charges and ensure that your loan does not become a long-term financial burden. 1. Prioritize high-interest debt. If you've taken out multiple loans or lines of credit, focus on paying down the debt with the highest interest rate first. This strategy, known as the avalanche method, can help you save money in the long run by minimizing the amount of interest you accrue. How it works. 1. Pay the minimum required on all loans but allocate any extra funds to the loan with the highest interest rate. 2. Once that loan is paid off, move on to the next highest, and so on. Benefits. 1. Saves more money in interest charges over time compared to paying all debts equally. 2. Helps to chip away at the most costly debt first, reducing financial stress. 2. Explore loan refinancing options. If you find yourself struggling to keep up with large monthly payments, refinancing your loan might be a solution. Refinancing can help lower your interest rate or extend the loan term, reducing the financial strain of repayment. What is loan refinancing? Refinancing involves taking out a new loan to replace your existing one. This new loan will often have different terms, such as a lower interest rate or a longer repayment period. When to refinance? 1. If interest rates have dropped since you took out your loan. 2. If your credit score has improved, making you eligible for better rates. 3. If you need to reduce your monthly payments to fit within your current budget. Risks of refinancing. 1. Extending your loan term can increase the total amount of interest you pay over time, even if the monthly payments are lower. 2. There may be fees associated with refinancing that could offset some of the savings. 3. Automate your payments to ensure that you never miss a loan payment. Consider automating your monthly payments. This strategy eliminates the risk of late fees and protects your credit score from being negatively impacted by missed payments. Benefits of automated payments. 1. You'll never have to worry about forgetting a payment. 2. Many lenders offer small interest rate reductions, for example, 0.25%, if you set up autopay. Best practices. 1. Ensure you have enough money in your account before the payment is withdrawn to avoid overdraft fees. 2. Regularly review your loan statements to ensure payments are being applied correctly. 4. Make extra payments when possible if your financial situation improves. Making extra payments toward your loan principal can significantly reduce the overall cost of your loan. Even small additional payments can make a big difference, especially over a long-term loan. How extra payments work. 1. The additional funds go directly toward reducing the principal balance of your loan, rather than paying off interest. 2. This reduces the amount of interest that accrues in the future, effectively shortening the repayment term. Tips for making extra payments. 1. Specify that the extra payments should be applied to the loan principal. 2. Even making an extra payment once a year can help you pay off your loan faster. 5. Consider debt consolidation for multiple loans. If you've taken out several loans or lines of credit, consolidating your debts into one loan can simplify repayment and potentially lower your interest rates. What is debt consolidation? Debt consolidation involves taking out a new loan to pay off multiple smaller debts. This leaves you with just one loan and one payment to manage each month. Benefits of debt consolidation. 1. Simplifies your monthly payments. 2. May result in a lower overall interest rate, especially if you consolidate high-interest credit card debt. 3. Can help you avoid missing payments by having fewer due dates to track. Potential drawbacks. 1. Consolidating may extend the term of your debt, meaning you'll pay more in interest over time. 2. Some consolidation loans come with fees that could negate some of the savings. Chapter 12. Building wealth after securing personal funding. Once you've successfully secured and managed your personal funding, the next step is using that capital to build long-term wealth. Whether through smart investments, business growth, or real estate, personal funding can be a springboard to financial independence. 1. Smart investment strategies. Personal funding can be used to invest in assets that generate long-term returns, including stocks, bonds, mutual funds, or ETFs. With a well-thought-out investment strategy, you can grow your wealth over time and potentially multiply your initial funding. Types of investments. 1. Stock market investments, buying shares in companies with high growth potential. 1. This option can offer high returns but also comes with risk, so it's essential to diversify your portfolio. 2. Bonds, a safer investment that offers steady returns. 2. While bonds typically offer lower returns compared to stocks, they are less risky. 3. Real estate. Purchasing real estate with loan funding can provide long-term wealth through property appreciation and rental income. Tips for successful investing. 1. Diversify your investments to reduce risk. 2. Focus on long-term growth, avoiding the temptation of short-term gains. 3. Consider working with a financial advisor to create a personalized investment plan. 2. Business growth and expansion. If you've used personal funding to launch or grow a business, you can focus on scaling that business to create sustainable wealth. Expanding your business into new markets, launching new products, or investing in marketing and technology can propel you toward greater success. Key strategies for business growth. 1. Expanding your market. Look for new geographic regions or customer segments that would benefit from your products or services. 2. Investing in marketing. Use a portion of your funding to boost your marketing efforts. 2. Effective campaigns can help you reach more customers and increase revenue. 3. Technology upgrades. Investing in technology can streamline your operations, making your business more efficient and scalable. Avoiding common business pitfalls. 1. Don't overextend your resources when expanding. 1. Growth should be sustainable. 2. Keep a close eye on cash flow to ensure that your business remains solvent during expansion. 3. Real estate opportunities. Real estate is another powerful tool for building wealth. Whether you invest in rental properties, commercial real estate, or house flipping, using personal funding to enter the real estate market can yield significant returns over time. Types of real estate investments. 1. Residential rentals. Purchasing properties to rent out to tenants provides a steady stream of passive income. 1. As property values appreciate, you can also profit from selling the property later. 2. Commercial real estate. Investing in office spaces, retail shops, or industrial properties can provide even higher returns, but typically requires more capital and management. 3. House flipping. Purchasing homes at a low price, renovating them, and selling for a profit is another way to use personal funding. 3. While riskier, house flipping can yield high returns with the right strategy. Tips for success in real estate. 1. Research local real estate markets to identify areas with high growth potential. 2. Work with a real estate agent or financial advisor to navigate the complexities of property investment. 3. Plan for unexpected expenses, such as property maintenance, taxes, or tenant turnover. Chapter 13. Inspiring stories of success with personal funding. Nothing is more motivating than hearing stories of others who have used personal funding to transform their lives, achieve their dreams, and create lasting financial security. 1. John's journey. From $50,000 loan to thriving business. John was an aspiring entrepreneur with a great idea for a tech startup but didn't have the capital to make it a reality. After securing a $50,000 personal loan, he invested in product development and marketing, launching his business within 6 months. Within 2 years, his company was generating over $500,000 in annual revenue. Today, John's business continues to grow, and he has used additional funding to expand into international markets. 2. Lisa's story. Using personal funding to build real estate wealth. Lisa used personal funding to purchase her first rental property, a small duplex. Over time, she reinvested her rental income to purchase more properties, growing her real estate portfolio to over 10 units in 5 years. Today, she enjoys a steady stream of passive income, allowing her to leave her corporate job and focus full-time on managing her properties. 3. Michael's tale. Funding his dream car collection. For Michael, personal funding wasn't about starting a business, it was about fulfilling a lifelong passion for automobiles. With a $200,000 personal loan, he was able to start collecting classic and exotic cars, a hobby he had dreamed of for years. Michael now owns a prized collection that not only brings him immense joy but has also appreciated in value over time, proving that following your passion can be a financially sound decision as well. Chapter 14. Looking to the future. Securing personal funding can open the door to countless opportunities, whether it's starting a business, investing in real estate, or achieving personal financial milestones. As you look to the future, remember that with careful planning, smart financial management, and a clear vision of your goals, you can transform that funding into lasting wealth and success. The journey may have its challenges, but armed with knowledge and determination, you can navigate the path to financial independence and reach heights you never thought possible. The key is to keep learning, stay disciplined, and always look for ways to maximize the value of every dollar you receive. Chapter 15. Navigating personal funding for lifestyle enhancements. While many seek personal funding for business ventures or real estate investments, some individuals use these financial tools to enhance their lifestyle, whether by traveling the world, investing in higher education, or funding personal passions such as art or sports. Leveraging funding for lifestyle improvements can be just as transformative as using it for business. 1. Travel the world with personal funding. For many, one of life's greatest pleasures is the ability to travel and experience different cultures, landscapes, and histories. However, travel can be expensive, especially for those with aspirations of long-term exploration or luxury experiences. Personal funding can provide the means to make lifelong travel dreams come true. How to use personal loans for travel. 1. World tours. Fund a round-the-world trip with personal loans, allowing you to explore different countries, stay in luxury accommodations, and enjoy immersive experiences. 2. Luxury vacations. Whether it's a private yacht trip or a luxury safari, personal funding can make it possible to enjoy once-in-a-lifetime vacations. 3. Cultural immersion. Spend extended time in one location, learning the language, culture, and lifestyle of a particular region without the financial stress. Tips for travel financing. 1. Set a clear travel budget and apply for funding that matches your needs. 2. Consider combining personal funding with travel rewards from credit cards to maximize savings on flights and accommodations. 3. Ensure your repayment plan fits your financial situation upon return, especially if you plan on taking time off work to travel. 2. Funding for education and personal development. Education is a lifelong investment, whether it's formal schooling, certification programs, or personal development courses. Many individuals seek personal loans to finance additional education that can lead to career advancements or personal growth. Education funding options. 1. Higher education. Use personal loans to pay for tuition, books, and living expenses while pursuing an undergraduate, graduate, or professional degree. 2. Certification programs. Specialized courses in fields like IT, healthcare, or business management often require additional funding for certification fees and materials. 3. Personal development courses. Investing in skills such as public speaking, writing, or leadership can lead to new career opportunities. 3. Personal loans can cover the costs of workshops, online courses, and seminars. Benefits of education funding. 1. Enhances your career prospects, often leading to higher earning potential. 2. Allows you to pursue passions that require specialized knowledge or training. 3. Personal growth, leading to greater confidence and life satisfaction. Risks to consider. 1. Avoid taking out more funding than necessary, as the debt from education loans can be significant. 2. Make sure the program or course you're investing in has a clear return on investment, ROI, whether that's career advancement or personal fulfillment. 3. Funding hobbies and personal passions. Some individuals use personal funding to fuel their passions, whether it's collecting art, starting a classic car collection, or pursuing a high-end hobby such as yachting or horseback riding. While these are often considered luxury expenses, they can bring immense joy and fulfillment to life. Popular lifestyle hobbies funded by personal loans. 1. Art and collectibles. Invest in artwork, antiques, or rare items, either as a financial investment or for personal enjoyment. 2. Car collections. Build a collection of classic, exotic, or vintage cars with funding, or restore a vintage car to its former glory. 3. High-end sports. Fund equipment and training for high-end sports like golf, skiing, or equestrian activities. How to use personal funding for hobbies. 1. Clearly define the scope of your passion project, including all associated costs. 2. Create a detailed budget to ensure that your hobby is financially manageable. 3. Look for ways to monetize your hobby, whether through selling collectibles, participating in tournaments, or offering workshops. The joy of funding personal passions. 1. Investing in hobbies or passions can enhance your quality of life, provide stress relief, and allow you to immerse yourself in activities that you love. 2. Many hobbies can appreciate in value over time, particularly art and car collections, making them both enjoyable and financially sound investments. Chapter 16. Overcoming challenges in personal funding. While personal funding offers great opportunities, it also comes with its challenges. Knowing how to overcome these obstacles will help you use your funding wisely and protect your financial future. 1. Avoiding debt overload. The temptation to borrow more than you need can be strong, especially if you're approved for a large loan or line of credit. However, excessive borrowing can lead to unmanageable debt and financial strain. Tips to avoid debt overload. 1. Only borrow what you can reasonably repay within the loan terms. 2. Create a realistic budget that includes your monthly loan payments, living expenses, and a cushion for unexpected costs. 3. Use any excess funds wisely, reinvesting in income-generating opportunities or paying down your principal early to avoid excess interest. 2. Managing risk in business ventures. If you're using personal funding to start or grow a business, it's important to account for the inherent risks. Many businesses fail in their first few years, so you'll want to have a strong plan in place to protect both your investment and your personal finances. Risk management strategies. 1. Create a detailed business plan with conservative financial projections. 2. Consider taking out business insurance to protect against unforeseen losses. 3. Separate personal and business finances to avoid personal financial damage if the business struggles. 3. Dealing with unexpected life events. Life is unpredictable, and unexpected events, such as medical emergencies, job loss, or economic downturns, can make loan repayment difficult. Having a plan for managing your loan in times of financial hardship is crucial. Preparing for the unexpected. 1. Build an emergency fund before taking out large personal loans. 1. Aim to save at least 3 to 6 months' worth of living expenses. 2. Consider insurance options, such as disability insurance, to cover loan payments in the event of job loss or illness. 3. Communicate with your lender if you experience financial hardship. 3. Some lenders offer forbearance or deferment options, allowing you to temporarily pause payments. Chapter 17. Achieving long-term financial freedom. The ultimate goal of securing personal funding is not just to achieve immediate goals but to build long-term financial freedom. Financial independence allows you to pursue your passions, live without debt, and enjoy a life filled with opportunity. 1. Focus on long-term wealth building. Using personal funding as a tool for long-term wealth building can set you on the path to financial independence. Whether through real estate, investments, or business ventures, it's important to make decisions that will yield long-term returns. Key wealth building strategies. 1. Invest in appreciating assets. Focus on assets like real estate or stocks that increase in value over time. 2. Reinvest profits, whether from a business or investment portfolio. Reinvesting your returns helps compound your wealth over the long term. 3. Reduce debt. Pay down high-interest debt as quickly as possible to free up more of your income for investments and savings. 2. Live below your means. One of the simplest but most effective ways to achieve financial freedom is to live below your means. By maintaining a lifestyle that costs less than what you earn, you can save and invest more, putting yourself in a position to achieve long-term goals. Living below your means. 1. Prioritize saving and investing over spending on luxury items. 2. Avoid lifestyle inflation as your income grows. 2. Instead, focus on growing your savings and investments. 3. Budget carefully and stick to financial goals that prioritize long-term security over short-term pleasure. 3. Plan for financial independence. Achieving financial independence takes planning, discipline, and patience. Set clear goals for when you want to be debt-free, how much you need in savings, and the lifestyle you want to lead. Steps to achieving financial independence. 1. Create a timeline for paying off all personal debt, including mortgages, student loans, and personal loans. 2. Set aside regular contributions to retirement accounts or investment portfolios. 3. Continuously educate yourself on personal finance, investing, and wealth-building strategies to stay ahead of the curve. Conclusion: unlocking the power of personal funding. Personal funding can be a powerful tool when used strategically. Whether you're starting a business, investing in real estate, or funding a passion project, the key is to plan carefully, manage risks, and focus on long-term financial health. By applying the strategies and principles discussed throughout this guide, you can unlock the potential of personal funding and transform your financial future. Remember, the journey to financial freedom is not always easy, but with discipline, knowledge, and persistence, you can achieve your goals and create a life filled with opportunity and success. Chapter 18: Strategic Use of Personal Funding for Wealth Accumulation. One of the most powerful aspects of personal funding lies in its potential to accelerate wealth accumulation. When used strategically, borrowed capital can multiply your assets, create multiple income streams, and lay the foundation for generational wealth. However, like any financial tool, it requires knowledge, discipline, and a clear plan to ensure success. 1. Leveraging personal loans for investments. Investing borrowed money may seem risky, but it can be a powerful wealth-building strategy if done wisely. The key is to ensure that your expected returns from investments exceed the interest rates on the loans. Examples of investment opportunities using personal funding. 1. Stock market investments. Personal loans can provide the capital to buy stocks, bonds, or mutual funds. 1. By carefully selecting growth or dividend-paying stocks, you can create a portfolio that generates long-term wealth. 2. Real estate investments. Many successful real estate investors started with personal loans, using them for down payments or property improvements. 2. With proper market research and timing, real estate can offer significant returns. 3. Alternative investments. You can also explore alternative investment opportunities like peer-to-peer lending, cryptocurrency, or art and collectibles, provided you thoroughly understand the risks and potential rewards. Risks and considerations. 1. Investment returns are never guaranteed. 1. Be prepared for potential losses, especially in volatile markets like the stock market or cryptocurrency. 2. Make sure the loan interest rate is manageable and doesn't negate your investment returns. 2. Aim for investments with strong potential for high ROI. 3. Diversify your investments to mitigate risk. 3. Don't rely on a single asset class to carry your portfolio. 2. Scaling a business with personal funding. Using personal funding to grow or scale a business is one of the most effective ways to achieve long-term financial independence. Many entrepreneurs take out loans to invest in new products, marketing, or expanding operations, with the goal of increasing revenue and profits. Effective business scaling strategies using personal loans. 1. Product expansion. Use personal funding to develop and launch new products or services that can expand your market and customer base. 2. Marketing and advertising. Invest in aggressive marketing campaigns, such as digital ads, influencer partnerships, or large-scale promotions to drive sales growth. 3. Technology and innovation. Modernizing your business by investing in technology, such as automation software or e-commerce platforms, can improve efficiency and boost profits. Business success stories. Many notable companies started with personal loans or small-scale funding. Amazon, Apple, and Google were all born from entrepreneurs leveraging small amounts of capital to build world-changing businesses. These stories highlight the potential of using personal funding strategically to achieve monumental success. 3. Personal funding for passive income streams. One of the best uses of personal funding is to invest in passive income streams. This approach allows you to earn money with minimal ongoing effort, ultimately freeing up your time for other pursuits while your wealth grows. Passive income opportunities. 1. Rental properties. A personal loan can help cover the down payment on a rental property. 1. Rental income can provide a steady, passive cash flow while the property appreciates over time. 2. Dividend stocks and bonds. Investing in dividend-paying stocks or bonds provides regular income in the form of interest or dividends. 3. Digital products or e-commerce. If you're tech-savvy, creating digital products, e-books, courses, etc., or investing in dropshipping businesses can generate passive income once the initial setup is complete. The power of compounding passive income. As passive income streams grow, reinvesting the profits into additional opportunities creates a compounding effect. Over time, this can exponentially increase your wealth, all while minimizing the time and effort you put into managing the investments. Chapter 19: Building Financial Security Through Debt Management. While personal funding can unlock numerous opportunities, proper debt management is crucial to maintaining financial security. It's easy to become overwhelmed by debt if you don't plan properly, but with the right strategies, you can ensure that borrowing leads to financial growth rather than hardship. 1. Debt consolidation and refinancing. If you have multiple high-interest debts, such as credit cards or payday loans, consolidating or refinancing them through a personal loan can save you money and simplify your repayment process. Benefits of debt consolidation. 1. Lower interest rates. Personal loans often offer lower interest rates than credit cards, reducing the overall cost of your debt. 2. Simplified payments. Instead of juggling multiple monthly payments, debt consolidation allows you to make one manageable payment. 3. Improved credit score. By paying off high-interest debts and keeping up with personal loan payments, you can improve your credit score over time. Refinancing strategies. 1. If you already have a personal loan with a high interest rate, consider refinancing it when interest rates drop. 1. This can significantly reduce your monthly payments and the overall cost of the loan. 2. Always calculate the total cost of refinancing, including any fees or penalties, to ensure it's a beneficial move. 2. Creating a personal debt payoff plan. Whether you're using personal loans for investments, business growth, or lifestyle improvements, it's essential to have a solid plan to repay your debt. A well-structured repayment strategy ensures that you avoid financial stress while still pursuing your goals. Creating a payoff strategy. 1. Avalanche method. Focus on paying off your highest interest loans first while making minimum payments on the rest. 1. This minimizes the amount you pay in interest over time. 2. Snowball method. Start by paying off your smallest loan balance first. 2. This builds momentum as you gradually eliminate debts and feel the psychological satisfaction of clearing each one. 3. Debt repayment timeline. Establish a realistic timeline for becoming debt-free. 3. Factor in your income, expenses, and any changes in financial circumstances, such as a promotion, job loss, or unexpected windfall. Maintaining discipline in debt management. 1. Stick to your payoff plan and avoid taking on new debts while you're in repayment mode. 2. If you receive unexpected income, such as a tax refund, bonus, or gift, use it to make an extra payment toward your loan principal. 3. Avoid lifestyle inflation. 3. Just because you've secured funding doesn't mean you should increase your spending habits. 3. Emergency funds and financial safety nets. Life is unpredictable, and even the best-laid financial plans can be disrupted by unexpected events. Maintaining an emergency fund is critical to ensuring that personal funding doesn't lead to financial hardship in the event of job loss, illness, or economic downturns. Building an emergency fund. 1. Set aside 3 to 6 months' worth of living expenses in a high-yield savings account. 1. This fund should cover rent/mortgage, utilities, groceries, and any minimum loan payments. 2. Avoid using your emergency fund for non-essential purchases or investments. 2. It should be reserved for true financial emergencies. 3. Consider automated savings programs or apps to help you consistently contribute to your emergency fund without thinking about it. Additional safety nets. 1. Look into insurance options that can protect you from financial loss, including health insurance, disability insurance, and business interruption insurance. 2. Keep an open line of communication with your lender. 2. If you experience a financial hardship, some lenders may offer temporary payment relief, such as forbearance or extended payment plans. Chapter 20. The future of personal funding. The world of personal funding continues to evolve, with new technologies, financial products, and platforms emerging to provide individuals with more opportunities and flexibility. From peer-to-peer lending platforms to cryptocurrency-backed loans, the future of personal funding offers a wealth of possibilities. 1. Peer-to-peer lending and crowdfunding. As traditional financial institutions tighten their lending criteria, peer-to-peer lending and crowdfunding platforms have risen in popularity. These platforms allow individuals to borrow money directly from other individuals or groups, often at competitive interest rates. Advantages of peer-to-peer lending. 1. Lower barriers to entry. Peer-to-peer platforms may have less stringent credit requirements compared to banks. 2. Personalized loan terms. Borrowers and lenders can negotiate loan terms that work best for both parties, offering greater flexibility. 3. Social impact. Crowdfunding platforms allow individuals to borrow money for personal projects, creative ventures, or charitable causes, creating a sense of community support. Popular peer-to-peer and crowdfunding platforms. 1. Lending Club, a well-known peer-to-peer lending platform that connects borrowers with investors. 2. GoFundMe, primarily for charitable causes. GoFundMe allows individuals to raise money for personal emergencies, medical expenses, or community projects. 3. Kickstarter/Indiegogo. These platforms are great for creative ventures, allowing entrepreneurs to secure funding for innovative projects and products. 2. Cryptocurrency and blockchain-based loans. Blockchain technology and cryptocurrencies are rapidly changing the financial landscape, including the world of personal loans. Platforms like BlockFi and Celsius Network offer cryptocurrency-backed loans, allowing individuals to borrow funds using their digital assets as collateral. How crypto-backed loans work. 1. Borrowers pledge cryptocurrency as collateral in exchange for cash or stablecoins. 2. The loan is typically issued at a lower interest rate than traditional loans, as the crypto collateral is seen as a valuable asset. 3. The borrower pays the loan in installments or at the end of the term, at which point they can reclaim their collateral. Benefits of cryptocurrency loans. 1. Quick approval. Because the loans are backed by crypto, approval is often faster than traditional loans. 2. No credit checks. Your credit score isn't a factor in the loan approval process, making these loans accessible to a wider range of individuals. 3. Potential for asset growth. If the value of your cryptocurrency increases during the loan term, you may benefit from significant gains. Risks to consider. 1. Volatility. Cryptocurrencies are highly volatile, and a market downturn could affect your ability to repay the loan or reduce the value of your collateral. 2. Regulatory uncertainty. The legal landscape for crypto-backed loans is still evolving, and there could be future changes in regulation that impact borrowers. 3. Personalized loan products and AI-driven financial tools. The rise of artificial intelligence, AI, and big data analytics is transforming the way personal funding is offered. Financial institutions are using AI to offer more personalized loan products and better financial management tools. Innovations in personalized lending. 1. Credit scoring models. AI-driven credit scoring models are now able to assess non-traditional data, such as social media activity or utility payments, allowing more people to qualify for loans. 2. Smart contracts. Blockchain technology allows for the creation of smart contracts that automatically execute loan terms based on predefined conditions, reducing the need for intermediaries and legal disputes. 3. Loan marketplaces. AI-powered loan marketplaces help individuals find the best loan products by analyzing thousands of options based on their unique financial situation. Future of AI in personal finance. 1. Financial coaching. AI-driven financial coaching tools will help individuals create personalized strategies for debt management, investment, and wealth accumulation. 2. Predictive analytics. AI tools will be able to predict economic trends and help individuals make better decisions about when to borrow, invest, or pay off debt. 3. Automated repayment plans. AI can also assist with managing repayment plans, adjusting monthly payments based on income fluctuations and spending habits. Conclusion: personal funding opens the door to a world of opportunities, but it also requires careful planning, discipline, and a willingness to take calculated risks. By using the strategies outlined in this guide, you can leverage personal loans to build wealth, grow your business, and create financial security. Remember that each individual's journey is unique, and your success will depend on a combination of smart decision-making, perseverance, and adaptability. The future of personal funding is bright, with new technologies and financial products offering even more opportunities for those willing to take the leap. Stay informed, stay flexible, and use personal funding as a tool to achieve your financial dreams and goals.